Hey everyone, hope they're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing. If you want to follow me, it's at funny_finance. And if you want to join our community, finding-value.com. That's where I dive deeper into all of these subjects, topics, sectors looking for potential investment opportunities. We do have a coupon code Mayday that is still active. If you'd like to sign up for both the monthly and yearly memberships, that coupon code can apply and you get larger savings for the yearly membership. So, Grady, it's always good to get other opinions. We've got Grady here. Silver is in historical long awaited breakout mode with gold's mega breakout 11 months ago. The PM bull resumed. Then silver followed gold, said back in 2019, my price target is at least $370 an ounce and still is. There has truthfully never been a bigger opportunity or threat. So he still is gung ho, majorly bullish on silver, as am I. He says the mother of all legit looking probable cup and handles. We've got a breakout of the blue formation to the upside, and we are in the third bull move. The first one was the 70s, the second move was the 2000s, and now we've got a big move here in the mid 2020s occurring. He said first it had the picture perfect quintuple support back test to pink handle arc. Black line, gray line, blue line, plus the fib, 61.8%, last not shown. Then it formed the huge bluish blue expanding falling wedge as backtest pattern. And now it is in the bullish wave 3, moving up the right side of the pink handle. So we are all good in his opinion. Gold, I know we've had a recent gold pullback. In his opinion, the gold slingshot parabolic move is still in play. Sometimes the simplest chart is enough. And again, it's a 4-year parabolic base that we are ripping higher on for gold. And it's still in play. Nothing's changed. Don't get too worried about the short-term market gyrations. Grady, and here's another one from Grady. This is DBA, which is the agriculture commodities. So yes, as been posted for long, inflation has never backed down. Follow the charts, not the fake narratives. So it's called the agriculture bear market low back in June of 2020, and that's a proper call, not some vague question mark thing. Their narrative now is that inflation is backing down. That is not what the chart is telling us. Get ready, need to compensate for what is coming. The DBA monthly agricultural ETF ripping higher, and it still looks good to continue on higher. So that's Grady's opinions there. This is GM Friends, How the Economy Works, which is actually pretty accurate. So I'll start here. The economy weakens or economy is weak. They do QE. Inflation goes up, which goes to a high. They raise rates chasing inflation. They have a soft landing narrative. We get some sort of recession pullback. They lower rates in relationship to the slowdown in the economy. And then the economy is weak. That's why they lower rates. And then it just goes in a circle like this. That's all they do. Now, do we need a Federal Reserve? I'm just going to go right to it. No, we do not. And if we did not have a Federal Reserve, we would have zero federal income tax like we did before 1913. Zero federal income tax. That is where it comes from. We get this tax for them to jerk around this circle here, do this circle jerk, where they take money from us, and they have the ability to, quote, raise and lower interest rates and print money, even though the free market, basically already does that. What a waste. Semiconductor index, playtime is over. We've got a bearish formation in PHLX semiconductor, the big move lower. the consolidation up, and then the breakout of that trend line to the downside. Kind of interesting to see what this looks like here, because let me chart it for myself. That is the SOX. So this is SOX here. Yeah, so this is a big long-term pattern. You had a big breakout here, the big breakout in 2012. This was your recovery phase. So we went into an expansion phase of real estate. You usually get a peak when the commodities market bottoms. So commodities bottomed. They peaked in 2008, which is here. You get a three-hump consolidation. You break out of that. And this is your buy point to go long in SOX right there. And then you ride it all the way up. And right now we are seeing evidence of a potential breakdown that he's got here and what we've got there. So he must be talking about this breakdown here. So it's sold off. You can put a trend line on top of that guy there. And it's basically an inverted kind of pattern. And we are potentially breaking here, is what he's showing us in the shorter term. And that's what it looks like on the bigger, longer term picture. So that's what he's seeing, and I like seeing it for myself in the charts, not just taking for granted people's opinions. Coming down, we've got, have you seen this divergence between DBC divided by SPY, commodities versus stocks? We have a bullish divergence in the relative strength indicator, which is starting to move up or higher. And we've got a declining ratio, which will eventually, I think, turn. We've got lots of support right where we're at. You can see the three arrows of all the support that we've got previously and the bullish divergences before. And I think we could maybe potentially try to gain support here and turn this thing around. The bullish divergence is further strength behind that support rationale. The chart of the week sold, and this is high yield spread risk proxy weekly in the S&P 500. If you look at 2007, 2008, there was a squeezing in this high yield spread and it blew out. At the same time, if you look behind it in the black, we can see that the S&P 500 rolled over and had a big sell-off. Are we in a similar situation in the end of 2024 here, where we get a real low reading and this will blow out again and a peak in the S&P 500? Maybe. I don't know. We'll have to wait and find out. But that is something that we have to watch. Egon says, did you know in the years following the 2007-2008 global financial crisis, as interest rates were cut, gold prices surged from approximately USD 660 to around USD 1,600, an increase of over 140%. And that's those market conditions. The market conditions where the big tailwinds gather behind gold. And they gather behind gold when you get an interest rate cut. So again, you go back to the circle here. What we did is they did QE in 2020. Inflation came behind in 2020, 2021, 2022, and so forth. They raised rates in 21 and 22 aggressively. Then they stopped raising rates. They talk about soft landing. That's kind of where we're at today, and a potential recession that people could be pricing in. So we're located over here right now. And that's where when they go to soft landing, recession, and lower rates, this is where gold takes off, is right here. That's the market condition that gold takes off. It also has one final surge under QE. And then it bases or goes sideways when inflation is high and they raise rates. That's when it slows down. Just an FYI, if you guys want to know the market conditions it works under. Tommy says an important observation, the CAPE ratio currently is at 38.1x, just below the 38.3 peak reached during the 2021 market high. At the time, the 10-year yield was 1.5%. Today, it has risen to 4.4%. It's worth noting that we are now significantly above the 1929 peak levels as well. Valuations don't grow to the sky. So he thinks that we are probably in a overvaluation period, which I completely agree with. And in the market where it's undervalued are precious metals and commodities. That's the only spot that's undervalued. Everything else, well, emerging markets are undervalued too, but everything else that's America based is overvalued because of these CAPE ratios, which is your price to earnings ratio. You're paying a lot for it, put it that way. Richard Dias says maybe Gilbo is really a Canadian oil industry mole. Canada's green anti-oil and gas policies have instilled a fiscal discipline in the CEOs of oil companies that shareholders have been begging for 30 years. This has pushed free cash flow yields to record levels. And this is the Canadian energy sector free cash flow yield and CapEx. CapEx is capital expenditures. So they've really pulled back on capital expenditures. They have a 30-year low in real CapEx. It almost looks like a shoulder, a head, and a potential shoulder where we're going to come back up. A bottoming pattern is what I see. But we also see record free cash flow yield ripping higher ever since 2015. And that's a double bottom. We had a bottom in about 99 and then another bottom in 2015. Another thing to note here is the last bull market was this bull market here where free cash flow yields went up during this time frame. I do think that we're going to see another surge in free cash flow yields, but we could also see CapEx go up. It does look like a shoulder head shoulder where we could start moving on up a little bit. But that's what we've got for today, and it looks really good for free cash flow yields for the Canadian energy sector. Jesse Colombo says, after the election, gold and silver fell and Dogecoin soared. That's the kind of stupidity we're dealing with right now. Anyone who gives up gold for a get-rich-quick scheme, go ahead and be my guest. They deserve everything that is coming. Dogecoin ripping and then gold pulling on back. I'm in the physical metals camp where there are elements on the periodic table. I'm not in the crypto stuff, and I don't think I ever will be. And I know some people say, well, it's going up. We should all go in what's going up. It's like, guys, how do you value it? You can't. It's garbage. At least Dogecoin and all the rest, they're garbage. And it's like, what do you actually own? And in the market conditions that I think are coming, I think physical metals, specifically ones that have uses in society, like silver is going to be a big boy move because it's the number two commodity and oil is number one. So I think oil is going to do really well because we're going to get in a print fest where they have to print a bunch of money and that money's going to come into the system. It's going to put everything to a shortage. Oil's the number one commodity. Silver's number two. And people they don't want crypto. They just want what they can buy with it. It's not because of the great functionality of Dogecoin. It's not because of the great functionality of Bitcoin or Ethereum. They want real crap. They just want to get rich quick. That's all the reason that people are there. It's the same thing as the tulip mania. Now, how high can it go? I don't know. And some people will say, well, what if you're wrong? Well, then I don't participate in getting rich off of crypto if that's the case. And I will make my money through the assets that everybody wants and needs in order to survive in this world. And that's silver, which is a base material in a lot of the things that we use in electronics. And I'm going to continue to invest in the things that feed this and support the wealth of humans in society. Invest in assets. Peter Lynch, he says, there's no shame in losing money on a stock. Everybody does it. What is shameful is to hold onto a stock, or worse, to buy more of it when the fundamentals are deteriorating. This is Peter Lynch. Now, the difficult part is, for most people, what do the fundamentals look like when they are deteriorating? I would say inventory level increases if you're in the commodities sector. So if inventories go up and they look like they're going to go up continually for a long time, that would be fundamentals deteriorating and then holding on even though the fundamentals do not show that. That would be inflation not persisting. So it would be a we'll call it a housing market glut. inventory levels go way up and the prices start to fall and you get a deleveraging event. That could also be not a great time to hold through. But I don't see any of that. Another thing is the fundamentals could deteriorate based off of valuation levels too. You could state that the fundamentals are deteriorating because of the value, the lack of value that it's providing to you. But I don't see that right now with anything. And yes, we could go through a slowdown recession and things could fall for a period of time. But that doesn't mean that the fundamentals are deteriorating. That's a short-term market glitch, so to speak, for a period of time. And what people do is they try to time the short-term market moves, which leaves them exposed to losing a position under a sector that is increasing its fundamentals, its fundamental strength. So that's the biggest problem that I see is you would lose your positions in a strengthening fundamental case where you're trying to do short-term trading or timing. And there's a big risk of being left out where you sell, it goes up, and then you don't want to get back in again because you sold at a much lower level than the price is currently at. And that's where I had my shortfall back in the 2000s, where I was a new investor. I didn't know a fraction of what I know today, but I was trying to do the short term market timing crap. And the stocks really took off, and I never got back in because I just couldn't overcome paying more than what I sold it for. I just couldn't psychologically do it. So now I don't sell. I want to hold on to it until the fundamentals actually deteriorate, which is a long ways away. Alberta pushes for more oil pipelines to U.S. as Trump returns, says Bloomberg. Canada's Smith talks to Enbridge, Southbow about new conduits. That could be really good for Alberta oil. Really, really good. Get the pipelines in there. The more takeaway capacity you get, the shrinking between prices in certain areas are gonna basically stabilize. So I think that Canadian crude is going to go up substantially and close the gap between Canadian crude and West Texas Intermediate and Brent crude. It can all kind of come together, at least closer to each other. Ian says a failed move for Nasdaq 100 above the July highs and now well into the election gap. Not a great look here, and this is it selling off, coming back down, and potential support there. So we'll see what occurs here. I still think it's early. I can see a big gap here that maybe we're filling. We'll have to see what occurs after that. Here's the NASDAQ. So in 2021, 2022, it was all about the $17,000 level or point level. In 2024, 2025, it is all about the $20,000 level. If we break below that level, we could see a bigger pullback like we did when we broke through the 17,000 level. Ian Castle says, the longer I invest, the more I realize you get 1-2 really great opportunities every few years. The rest of the time is spent wondering if you will ever get another great opportunity again and convincing yourself to own mediocre opportunities while you wait. I would say yes, and it doesn't mean that you even get it, all the time. It's like entire sectors pull back. You get a real good opportunity to load up on them, and then you buy them. And another time that you get the great opportunities is when there's great fear in the market. That's your recession. So when you come around this circle here, this circle takes some time. If you look at this circle here and it goes around, recessions can come a little bit more frequently, but you got commodity to stock ratio. Commodities are on sale once every about 18 years. And same with stocks. They go on sale, like dramatically on sale, when you get these big recessions. And that's your big entry points. And Ian's completely right, saying that these opportunities don't come often because they don't. And that's the time that you want to load up in them. And it says time to be defensive. I can't imagine two better defensive companies than Johnson & Johnson and Procter & Gamble. Here we are NDX divided by JNJ and PG. So the red zone here, the risk zone up there, buy zones are low down here. And I agree that these buy zones here, that's after the recession. That's 2008 down to 2000. This is 2001. This is 2008, 2009. Those are the two areas, and that's your double bottom. You draw a line across, and you break out, and this is your stage two move higher. Now, where I think we're getting into the risk zone. I totally agree with this chart here. Totally agree. JC Parrott says the spectacular underperformance out of technology stocks continues, and no one wants to talk about it. Good. The small cap tech coming on down. This is XLK divided by the S&P 500 large cap tech, and it looks like it's could be underperform and move on lower. And Charlie Munger's 5 investment skills to develop. So number 1, the ability to keep raw, irrational emotions under control. 2 is patience. 3 is discipline. 4 is an ability to take losses and adversity without going crazy. And 5, the ability to not be driven crazy by extreme success. That's what he says for the 5 investment skills to develop. Global crude oil consumption's at 103 million barrels per day. There we are heading higher, and I don't see the rollover at least yet, but it does look pretty strong, and we've been moving on up. Susie Orman said that 2 million is not enough, and one cannot retire on it. That's her opinion. Kevin says, of note today, a $4 per pound jump in uranium price seems to be waking up. URNM and URNJ have bottomed. Reading about demand surge coming in molybdenum in Europe. Price is moving up. If so, Molly will be off to the races. And with permits advancing to completion, it could get very exciting. I'm told solid presentations by management in various parts of Europe have been taking place. But that's what I've got for today, guys. That's where we're going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. With that May Day coupon code, we do have a question and answer session today, 5 p.m. Mountain Time. We'll see you there. Bring your questions. We already have some people that have sent me questions beforehand that I will answer during that Q&A in the beginning. But that's what I've got for today. We'll catch you next time. This is Finding Value.